Breaking news. If you have over £3,500 sitting in a savings account, this could have serious implications for you. In a shocking financial alert, His Majesty's Revenue and Customs, HMRC, has issued a stern warning that could catch millions of UK savers off guard. If your savings exceed that threshold, you may be unwittingly attracting the attention of tax authorities. This isn't just a casual heads-up, it's a serious caution that you could soon face an unexpected tax bill. Here's the lowdown on what's happening and why you must act now before it's too late. As we dive into the new tax year for 2025 to 2026, HMRC has ramped up its scrutiny of savings interest. Many people are unaware that the interest accrued on their savings isn't invisible to HMRC. In fact, it's far from it. Banks and financial institutions are mandated to report the interest you earn directly to HMRC automatically. Unless your savings are parked in a cash ISA, which remains tax-exempt, any interest you generate could influence your taxable income. This is especially critical for those who don't usually file a self-assessment tax return. You might think you're in the clear, but your bank could be quietly sending over information that might result in an unwelcome letter from HMRC demanding additional taxes. Let's dissect this. The UK government has established a personal savings allowance, PSA, a tax-free threshold for interest income. For basic rate taxpayers earning up to £50,270 annually, this allowance stands at £1,000. However, if your income surpasses that figure, the PSA reduces to a mere £500. For higher earners making over £125,000 each year, the allowance completely disappears, meaning you get no tax-free interest whatsoever. Any interest earned beyond these limits is taxed at your standard income tax rate, which can be as high as 45%. So why is £3,500 suddenly a pivotal figure? Let's consider a scenario. Imagine you deposit £3,500 into a fixed-rate savings account offering 5% interest over 3 years. That sounds like a smart investment, but there's a snag. Many fixed-rate accounts disperse the total interest at the end of the term, rather than incrementally. This means that when the term concludes, you receive a lump sum of interest that could surpass your PSA for that tax year. For example, in this scenario, your lump sum interest would exceed £500, triggering a tax charge if your allowance is only £500. Things get more complicated. You might not even be aware that you're nearing the threshold. After all, £3,500 doesn't seem like a huge sum in savings. But when combined with other interest sources, like additional savings accounts, bonds, investment platforms, or even PPI payouts, you can easily exceed your tax-free limit without realizing it. When that happens, HMRC can and will intervene. For those employed or receiving pensions, they may simply adjust your tax code, discreetly deducting taxes from your salary or pension. You might not notice until your take-home pay suddenly drops or until you receive an unexpected letter from HMRC demanding payment. Now, consider larger sums. Suppose you've saved £11,000 in a savings account with a 5% annual interest rate. That generates £550 in interest. If your income exceeds £50,270, you're only permitted £500 of tax-free interest. The extra £50 is subject to tax. At a higher tax rate, let's say 40%, you'd owe £20 in tax. It may not seem substantial, but these charges can accumulate rapidly, especially if you have multiple savings or investment accounts. Even basic rate taxpayers aren't entirely safe. Imagine having £21,000 saved in an account at 5% interest. That yields £1,050 in a year, exceeding your £1,000 allowance by £50, which then becomes taxable. And let's be clear, it's not just traditional bank accounts that count toward your tax liabilities. The government's definition of interest income is much broader than you might think. Income from credit union accounts, peer-to-peer lending, investment trusts, open-ended investment companies, certain life insurance contracts, and even some PPI or trust fund payouts can all contribute to your PSA. Thus, if you have a varied financial portfolio, it's easier than ever to accidentally breach your allowance. So, what steps can you take? First, be mindful of your total income and interest earnings across all accounts. It might be time to consolidate your savings into tax-efficient options like cash ISAs, which remain exempt from income tax regardless of interest generated. Alternatively, consider staggering your savings across different tax years using fixed-term accounts to avoid a large lump sum being taxed in one go. Regularly checking your HMRC digital tax account, where your estimated interest income and tax code are updated based on bank data, is crucial. If you suspect an error or an unfair tax code adjustment, it's your responsibility to contact HMRC and rectify it. You might also want to consult a financial advisor, particularly if your savings are substantial or complex. A knowledgeable advisor can help you legally minimize your tax burden by directing funds into more efficient investment vehicles, planning withdrawals to keep you within thresholds, or advising on gift allowances and trust options. If you're thinking long-term, it's wise to review your savings interest annually. Don't wait for HMRC to contact you. Consider utilizing budgeting apps or financial tools that monitor interest and alert you as you approach your limits. Staying proactive can mean the difference between compliance and an unexpected tax bill. And don't ignore any letters from HMRC that arrive. Many people panic or assume they're scams, but neglecting to respond or update your information could lead to fines or interest on the owed amount. If you're self-employed or earn untaxed income, now is the time to register for self-assessment, even if you've never done so before. This allows you to accurately report your savings interest and other earnings, ensuring you pay what you owe before penalties kick in. In summary, having savings is a sound financial strategy, but it comes with responsibilities that you cannot afford to overlook. Even a modest nest egg could lead to unforeseen tax consequences. The best way to avoid an unpleasant surprise is to stay informed, plan strategically, and understand your standing with HMRC. So, if you've got more than £3,500 in savings, take a moment today to check your interest earnings and total income. Doing so might just save you from a nasty surprise down the line.